Hello everyone, welcome back. If you thought the metal story was going to cool off after the calendar flipped, you might want to sit down because in just a handful of trading days, gold and silver didn't just move, they snapped higher like a rubber band that's been pulled too far for too long. And the really wild part, most people still aren't paying attention yet. Now, quick favor before we dive in, I'm running a campaign to push back against copycat channels that rip off original work and flood YouTube with recycled noise. If you value what we do here, hit subscribe and drop OG John AG in the comments so I can point to real support when we take this fight public. All right, here's what we're doing today. I'm going to walk you through what's behind this sudden surge, why physical demand is behaving differently than most people realize, and the handful of pressure points that could act like a trigger this year. After that, we'll talk about the Federal Reserve drama, the debt problem nobody wants to price honestly, and what a world looks like when the dollar stops being the only ticket to the party. And near the end, I'm going to give you the one thing I'd watch like a hawk, because if it flashes, it changes the pace of everything. And yes, check the description after you watch because I left bonus links there for you, including the premium WhatsApp channel and the option to join channel membership if you want the deeper, more detailed breakdowns. Okay, let's jump in. First, let's put a frame around the move because the numbers matter, but the how matters even more. When gold can add hundreds of dollars in what feels like a blink, and silver can rip higher by double digits before most people finish their January plans. That's not a sleepy market. That's a market where liquidity is thinner than the public assumes and where positioning is already crowded in the wrong direction. And you can see it in the way people talk. 2 months ago, the tone was maybe later this year. 2 weeks into the new year, the tone is, wait, did we just teleport to the forecast? Because that's the funny thing about forecasts from big banks and big institutions. They love to publish price targets, $5,000 gold, $100 silver, when it feels far away. It's safe. It sounds smart, and it doesn't require urgency. But when price starts sprinting toward those targets early, the same voices suddenly get quiet, or they start warning about pullbacks, or they start pushing people into paper products that keep the control in the system. That's why I keep telling you, listen to what they do, not what they say. Now, about the physical market, this is where most analysis online becomes useless because it ignores the difference between a price and a product. Spot price is a reference. It's a number that updates fast. Physical product is a supply chain. It has inventories, minting schedules, wholesaler allocations, shipping constraints, and dealer risk management. So when demand spikes, the first thing you'll often see is not just spot moving, it's premium stretching. And if you've been around metals long enough, you know exactly what I mean. It starts with, wow, premiums are up a bit. Then it becomes, okay, the popular stuff is getting expensive. Then it becomes, why is everything backordered? And then one day, without warning, the market becomes a game of what can I actually get today? And that's the part most people don't emotionally prepare for. They assume markets are always liquid. They assume you can buy when you want and sell when you want. In a true stress event, that assumption breaks. Not because people are evil, because the pipeline was never built for a stampede. That's why those stories about trade shows and lines matter. When you hear about thousands of people waiting to get in, that's not a cute anecdote. That's a data point. It's a sign of cultural shift, people moving from passive spectators to active participants. And by the way, the public doesn't need to be right for their behavior to move the market. They just need to act in the same direction. Now let's talk about something people overlook. Why a mint would pause sales or adjust pricing during fast markets. On the surface, it looks like incompetence. Sometimes it is. But sometimes it's also risk control. If a mint sells product at a fixed price that falls behind spot, they become the cheapest supply in the world for about 5 minutes. And in that 5 minutes, everything gets vacuumed up. Then they're left with angry customers, angry dealers, and a political headache. So they hit the pause button, which tells you something else. When systems pause, it's because the move is fast enough that it threatens normal operations. That's not normal volatility. That's stress. And stress spreads because once buyers see pauses and suspensions, they interpret it as scarcity. And scarcity drives more demand. And more demand drives more pauses. That's how you get a feedback loop. Now, let me say something that will save you pain. If you're buying physical, don't anchor your decision on a perfect spot price. Anchor your decision on your plan. Because waiting for the perfect number in a market that's changing structure is how people get left watching from the sidelines while the train leaves the station. And yes, there will be pullbacks. There are always pullbacks. But pullbacks in a bull market are not the same as pullbacks in a dead market. In a bull market, pullbacks are often invitations, brief windows. In a dead market, pullbacks are traps, slow fades. Know the difference. All right. Now that we frame the move, we can talk about why it might keep going and why the next phase could be even more dramatic than the first. Because here's what most people don't realize. The early phase is usually led by the informed. The explosive phase is led by the crowd. And the crowd doesn't arrive with patience. The crowd arrives with emotion. That's why I keep using the word rush. Because at some point, this stops being a discussion and becomes behavior. So what flips the switch? It's often something small that reveals something big. It might be a treasury auction that goes wrong in a way they can't spin. It might be a sudden emergency facility announcement. It might be a surprise policy shift. It might be a foreign policy event that changes trade terms overnight. It might be a major bank admitting losses in an area everyone said was contained. And here's the key. The trigger won't be obvious before it happens. It will be obvious after. So instead of trying to predict the spark, focus on the gasoline. And the gasoline is everywhere. Debt is gasoline. Leverage is gasoline. Overconfidence is gasoline. And the belief that central banks can always keep everything smooth is gasoline. Now, I want to be very clear. I'm not rooting for chaos. I'm not hoping for hardship. I'm explaining the setup so you can protect yourself. Because if we're honest, the system is already asking you to accept a quiet loss. It's asking you to accept that your cash buys less every year. It's asking you to accept that your labor gets discounted. It's asking you to accept that normal is just a managed decline. And that's why people are waking up to wealth preservation as a concept, not as a buzzword, as a necessity. So if you're new here, let me put it in plain language. Gold and silver are not just a bet that price goes up. They're a refusal to be trapped in someone else's promise. And when enough people start refusing, the price adjusts. Okay, back to the main storyline. It's the start of 2026, and it feels like we skipped the slow build and went straight to the fireworks. Not long ago, people were arguing over whether gold could maybe touch the next psychological level sometime later this year. Meanwhile, the chart didn't ask permission. It just started climbing fast. Silver, too, went from interesting to are you seeing this in the time it takes most people to finish one paycheck cycle. And that speed matters because markets don't just move on price. They move on psychology. A steady grind higher builds confidence. A sharp spike builds attention. And attention is the fuel that brings new buyers into the room and sometimes forces weak hands to panic at the worst possible moment. So what changed? The simple answer is demand. But not just paper demand, not just funds clicking buttons. I'm talking about real physical demand. The kind you can't fake with a spreadsheet. The kind that shows up in lines out the door, empty shelves, delayed shipping, and dealers saying, I can get it, but not at yesterday's premium. I've been hearing the same thing from different corners of the market. Public interest is hotter than it was last year. And not the casual curiosity type, the I want it in my hand type. When people start thinking less like traders and more like savers, that's when the game changes, because a trader can sell in 5 seconds. A saver doesn't sell. They stack, they tuck it away, they forget about it, and that metal disappears from circulation. That's how you get tightness, that's how you get stress, and that's how you get price moves that feel sudden to the crowd, even though the setup was building for months. Now here's something that should make you raise an eyebrow. The official mint situation. There's been talk about certain coin programs being paused, adjusted, or temporarily suspended, especially on the silver side, because the system can't keep up with the speed of price changes. And I know the easy reaction is to laugh and say, how can a modern institution not handle a changing spot price? But don't miss what that implies. If an organization with infrastructure, budgets, and bureaucracy is struggling to price product in a fast market, imagine what that means for the average buyer who waits for the perfect dip. Imagine what it means for the people who assume supply is endless because they can always click add to cart. Here's the truth. In a real squeeze, supply doesn't vanish all at once. It disappears in layers. First, you lose the cheapest options, then you lose the popular options, then you lose the immediate delivery, then you lose the ability to lock a price without a time limit. And by the time the public realizes what's happening, the market isn't just higher, it's thinner. And thin markets can do violent things. Now, I can already hear someone saying, okay, but what's the trigger? What's the big event? What's the moment that makes this go from spicy to historic? Let's talk about that carefully, because anyone who claims they can predict the exact day and hour of a financial shock is either guessing or selling something. But that doesn't mean we can't identify the pressure points. We can. And when enough pressure points line up, the probability of a crack goes way up. So here are the big ones I'm watching. First, the debt spiral. Debt isn't just big. Debt is becoming self-feeding. The interest on the debt demands more borrowing, and that borrowing creates more interest. That's not a political statement. That's math. And here's the part people miss. You don't need debt to hit infinity for the problem to explode. You just need the market to lose confidence that it can be managed without destroying the currency. That's when you see higher risk premiums. That's when financing costs climb. And that's when governments face the choice they hate. Cut spending, raise taxes, or print. You already know which one they pick. Second, treasury market stress. You can call it weak auctions. You can call it lack of buyers. You can call it temporary imbalance, but if the largest debt market on earth starts showing repeated signs of indigestion, that's not a normal headline. That's a warning light. Because treasuries are the foundation of the modern financial system. They're collateral, they're reference rates, they're the risk-free benchmark that everything else leans on. So if that foundation starts wobbling even slightly, the entire structure feels it. Third, commercial real estate. This is the slow-moving train that people keep pretending isn't on the tracks. A lot of loans were written in a different world, different valuations, different occupancy, different assumptions. Now, refinancing happens at higher rates and suddenly fine becomes underwater. And the problem isn't just the buildings, it's the exposure, the leverage, the derivatives, the interconnected balance sheets that nobody wants to mark honestly until they're forced to. And when they're forced, that's when you get surprises. Fourth, global dollarization pressure. Now, I'm not here to tell you the dollar disappears tomorrow. That's not how systems work. But I am telling you the world is experimenting more openly than it used to, with settling trade outside the dollar, building regional arrangements, and increasing gold's role in trust and settlement. Even if those experiments are small today, they matter because they create a path. And once a path exists, adoption can accelerate fast, especially during crisis. Fifth, the control response. Digital rails, central bank, digital currencies, tighter payment networks, more surveillance disguised as stability. That stuff doesn't show up because everything is healthy. It shows up because the system is preparing for stress and wants tools to manage behavior. And if you think those tools won't be used, I've got a bridge to sell you. Now here's the scary part. You probably don't get one trigger, you get a combo. And combos are what create real shocks. A soft treasury auction, plus a big debt headline, plus a commercial real estate wave, plus geopolitical tension. And suddenly, confidence slips. Then the machine starts feeding itself. Markets tighten, volatility rises, people look for safety, and gold and silver do what they've always done. When trust gets questioned, they get repriced. And that brings me to the inflation conversation, the one where people feel like they're being gaslit. You hear inflation is steady. Inflation is cooling, inflation is manageable, then you go to the grocery store, then you pay insurance, then you renew a subscription, then you try to eat out, and you think, am I losing my mind? You're not. Here's what steady inflation really means. It means prices are still rising, just at a rate that looks nicer on a press release. It does not mean your purchasing power returns. It does not mean the old prices come back. It means the loss continues just on a smoother slope. And that's why the metals move matters, because gold and silver don't need inflation to look dramatic to rise. They need confidence in currency to weaken. And confidence weakens when people realize the game is print, promise, repeat. Now let's talk about the Federal Reserve angle, because it's getting weird. There's been a lot of noise about renovations, budgets, politics, interest rates. This tug-of-war where one side wants lower rates yesterday and the other side wants to look independent while still keeping the system from breaking. Here's my take. Multiple things can be true at once. Yes, it's strange for a private-ish institution with enormous power to operate like it's above scrutiny. It's also true that lowering rates solves problems in the short run. Refinancing, liquidity, asset prices, optics. And it's also true that keeping rates high reveals cracks because high rates are like a flashlight on leverage. So the question becomes, how long can they keep the flashlight on before something ugly crawls out? That's the real story. Because if rates stay elevated, weak debt breaks. If rates fall, currency gets sacrificed faster. Either way, the saver pays unless they own assets that can't be printed. And that loops us right back to gold and silver. Now, what comes next if the dollar's dominance starts to fade at the margins? This is where you need to think like an architect, not a headline reader. I don't think we wake up to a single global coin that everyone loves. I think we drift toward a multi-rail system, regional trade blocks, basket-style accounting, settlement methods that reduce dependence on any one currency. And here's the critical point. Even a modest reduction in external demand for dollars has consequences. Why? Because when dollars aren't needed abroad, they don't disappear. They come home. And when they come home, they chase a finite amount of goods and services. That's inflation pressure. That's the kind that people feel, not the kind that gets smoothed in reports. That is how you get the conditions where everyday life gets expensive fast, even if official numbers lag. So if you're asking why gold and silver are acting like they have a mission right now, that's why. They're not just investments. They're signals. They're barometers. They're telling you what people think about the future value of paper promises. And speaking of signals, here's one that keeps getting ignored. Trust. Trust between countries is lower. Trust in media is lower. Trust in institutions is lower. Trust in fiat currencies is lower. And when trust declines, collateral matters more. Settlement matters more. Tangibility matters more. That's why central banks quietly and steadily treat gold like insurance, not because they're nostalgic, because gold has no counterparty risk. Now, I'm not saying we go back to a classic gold standard where every unit is directly redeemable on demand. That's a different era. But a system can be gold influenced without being gold standard. Gold can sit behind the curtain as a confidence anchor. Gold can be used for settlement. Gold can be used to balance trust deficits. And the more the world fragments, the more valuable neutral collateral becomes. That's the big picture. But let's pull it back down to street level for a second, because you're not a central bank. You're a person trying to protect your life, your family, your future. So what should you do with all this? First, don't get hypnotized by price. Yes, price is exciting. Yes, it's validating. But price is not the reason you own real assets. The reason is protection. The reason is optionality. The reason is to step outside a system where someone else can change the rules. Second, understand that physical demand is different than paper demand. When paper demand rises, price can spike and then fade. When physical demand rises, the market can tighten, premiums can jump, and availability can disappear. That's not theory. That's how it works. Third, decide your goal. Are you stacking for wealth preservation? Are you speculating for upside? Are you hedging against currency decline? Your plan should match your purpose. Otherwise, you're just reacting. And by the way, if you're one of the people who's already had a win, already made a smart move, already protected your savings, or improved your situation, share your success story in the comments. Seriously, other people need to hear that it's possible, and your story might be the thing that gives someone the courage to take action. Now, let me toss a question at you because I want to hear from you. Do you think the next break happens first in the debt market, the real estate market, or through geopolitics? Drop your pick in the comments and tell me why. And second question, are you stacking more gold, more silver, or staying balanced right now? Now, quick creative side note in the middle here. If you're also into silver-related success stories, people who used smart timing, discipline, and strategy to build real wealth, there's a link in the description to a separate channel that focuses on that. Check it out and subscribe over there too, because it's motivating to see what's possible when someone actually commits. All right, back to the plot. Let's talk about why this move feels different from other metal rallies people remember. Most rallies are driven by one dominant story, a crisis headline, a rate cut expectation, a geopolitical flare-up. But what we're seeing right now has multiple layers. We've got debt pressure. We've got political pressure on rates. We've got a public that's more financially literate than it was a few years ago because pain teaches faster than textbooks. And we've got institutions positioning for a world where money doesn't behave like it used to. And when those layers overlap, the market doesn't just trend, it jolts. Now, the mainstream financial media will always try to simplify this. They'll say it's profit-taking or risk on or risk off or some neat little label that fits in a headline box. But the real story is bigger. The currency is the story. Because you can't print your way out of a debt problem without printing your way into a currency problem. And you can't solve a currency problem with slogans. That's why people are on high alert. That's why people are asking about triggers, and that's why gold and silver are doing what they're doing. Now, let me give you a retention cliffhanger right here because this is important. If you only watch one part of this video all the way through, watch what I'm about to say next because this is where most people get trapped. Most people wait for confirmation. They want the headline that says, yes, now is the moment. They want the mainstream to bless the move. They want the banks to announce it's safe. But by the time the mainstream blesses it, the easy positioning window is usually gone. That's not me being dramatic. That's how narrative works. The crowd arrives late. So the real question is not will gold and silver be higher? The real question is, will you already be positioned before the crowd decides you were right? And that brings us to the practical side of the year. Here are a few dashboard items I keep coming back to, and I recommend you watch them too. Not because they're magical, but because they reveal where stress is hiding. One, the dollar's behavior versus everything else. People get fixated on the idea that the dollar must collapse for metals to rise. That's not true. The dollar can look strong on a scoreboard while still losing purchasing power in real life. A currency can be the cleanest shirt in a laundry basket full of dirty shirts and still be dirty. So watch the direction, but also watch what it buys. If gold and silver keep rising even when the dollar is stable, that's a sign the market is sniffing out deeper instability. 2. Real rates. When the return on safe cash-like instruments falls behind rising costs, savers start searching for escape hatches. That's when hard assets shine. You don't need hyperinflation for this. You just need the quiet theft to continue long enough that people finally notice. 3. Credit events. Not the dramatic ones that make movies, the slow credit events, defaults, downgrades, refinancing failures, especially in sectors that were overbuilt in the cheap money era. Credit is the bloodstream of the system. When it clots, everything gets cold fast. 4. Liquidity announcements. Pay attention to the moments when officials suddenly create a new facility, a new program, a new backstop, a new rule tweak. They will always frame it as temporary and technical. But if you see those announcements stacking up, it's usually because something broke behind the scenes. And here's the part that connects directly to metals. Every time the system needs a new backstop, it is admitting that the old promises weren't enough. That admission is bullish for hard assets. Now, I want to address the biggest trap I see people fall into during fast markets, the trap of Allen emotion. When price is ripping, people want to do something dramatic. They want to chase. They want to convert every dollar. They want to feel like they're not missing out. That emotional surge is exactly what creates tops in the short term. So if you're building a long-term position, think like a builder, not a gambler. You don't pour the entire foundation in one chaotic night. You build in layers. You buy in tranches. You keep dry powder. You protect your downside so you can stay in the game. That's not boring. That's how you win. Now, because I know someone will ask, what about paper metals? What about the ETFs and the futures and all of that? Look, paper has a role for some people, for some strategies, but paper is still inside the system. It's still counterparty risk. It's still dependent on rules you don't control. Physical is different. Physical is you opting out of that dependency. And the reason this matters is because in a real stress moment, paper can be settled in cash, changed by rule, restricted by policy, or simply become difficult to convert when everyone tries it once. Physical doesn't need permission. That's why when you see physical demand heating up, you should pay attention even if the headlines try to downplay it. Physical demand is the dog that doesn't bark until it bites. Now, let me drop a cliffhanger that most people won't like, but you need to hear. The next major move might not start in metals at all. It might start in something that seems unrelated, like a large pension fund shifting allocations, or a major foreign holder trimming treasury exposure, or a big institution quietly moving into collateral that can't be frozen. Those moves won't come with fireworks. They'll come with routine filings and bland language. But the moment they become visible, the market will already be repricing. So if you're waiting for a loud signal, you're already late. And this is exactly why we created the members-only research videos, so we can track these quiet signals and break them down without the noise. If you want, that membership is in the description, and it directly supports the team that helps produce those deeper dives. Okay, back to the year's practical side. If we do see a wave of negative real rates, meaning the